Hi everyone, I'm Wendy Estacio-Cruz and welcome to UTrade Rundown. US-Iran tensions are rising again and global markets are starting to react. Oil prices are climbing, risk sentiment is shifting, and investors are asking one key question. What does this mean for the Philippines and how should investors position? Here are the three things investors should know. First, oil prices are the immediate transmission channel. Iran sits near the Strait of Hormuz, one of the world's most critical oil shipping routes, where roughly 20% of global oil supply passes through. When geopolitical tensions rise in that region, markets immediately price in the risk of supply disruption. That's why oil prices often spike during these events. For the Philippines, this matters because we are a net oil importer. Higher global oil prices translate to higher fuel prices, transport costs, and upward pressure on inflation. And we've seen this playbook before. When the Russia-Ukraine war broke out in 2022, global oil and commodity prices surged. Inflation in the Philippines accelerated sharply, eventually peaking at around 8.7% in early 2023. To control inflation, the BSP raised policy rates aggressively from 2% in 2022 to as high as 6.25% in about a year. So, geopolitical shocks can quickly spill over into inflation and interest rate expectations. If inflation rises and the peso continues to weaken, the BSP may need to pause its easing cycle or shift toward defending the currency. If conditions tighten, economic activity could slow, which means stronger fiscal support from the government through infrastructure spending and public investment may be needed to help sustain growth. But here's what investors need to watch next. Overseas Filipino workers in the Middle East are a key economic exposure. Millions of Filipinos work across the Middle East, and their remittances are a major pillar of the Philippine economy. If tensions escalate significantly, risk could include employment disruptions, repatriation concerns, or economic slowdown in host countries. While this is not the base case today, it's important because remittances support household spending and overall economic activity in the Philippines. Now, how should investors position? Historically, geopolitical tensions tend to create short term volatility rather than long term structural market shifts. For investors, this means paying attention to sectors that benefit from higher commodity prices, such as energy companies. Meanwhile, sectors sensitive to rising fuel and borrowing costs like transportation, logistics, and consumer discretionary could face pressure if oil prices remain elevated and inflation picks up again. For traders, geopolitical headlines can trigger sharp but temporary market swings, creating tactical opportunities. Right now, the key driver to watch out is whether tensions escalate into real disruptions in global oil supply. And if that happens, the next story may not just be oil prices, but inflation and interest rates once again. And that's it for this week's UTrade Rundown. For regular market updates, open a UTrade account today.